Hello there, this is Dr. Smith going over your GDP quiz. Start with number one, which was my mistake. I told you that there wouldn't be a question on real GDP on your quiz, and here it is, a question on real GDP on your quiz. But if you got it wrong, I didn't count it against you. So real GDP means it's gross domestic product adjusted for inflation. Nominal GDP is not adjusted for inflation, means expressed in current prices. So B is actually the definition of nominal GDP. E is the definition of real GDP. Let's see. Oh, and purchased A, I wanted to just highlight this. GDP doesn't count what's being purchased. It counts what's being produced. The P in GDP stands for gross domestic production, not gross domestic purchases. All right, two's pretty straightforward, except, of course, the way that it's written. National income means the same thing as gross domestic product, because remember, there's an income expenditures identity. So if we said national production, national income, gross domestic product, it all means the same thing. So the only thing that would cause an increase in GDP would be a decrease in imports, because imports are subtracted from GDP. So remember, our GDP function is consumer spending plus investment spending plus government spending plus net exports, and net exports are equal to all of the exports minus all of the imports. Because if something is being produced in another country and then imported into, say, this country, those are things that are not being produced here in this country. So it is subtracted from our gross domestic production. Number three, investment, inventories count towards investment expenditures. You can kind of think about it as a business buying their own products. So when, say, a car company produces a bunch of cars in 2019, we're going to count those cars in GDP when they're produced in 2019. Now, if that company is able to sell the cars, great. We could count that in consumer spending. But if the car company is unable to sell the cars to anybody, then what we're going to do is calculate the value of those cars that remain in the company's inventory. And it doesn't matter if the company sells those 2019 cars in 2020. We would have already counted them in the investment sector in 2019. All right, and that kind of brings us to number four. So if a car was manufactured in 2006, but it wasn't sold in 2006, we would count this car right here in the investment sector, because that car would sit in the company's inventory. So in 2006, GDP would increase. In 2007, when the car's actually sold, there would be no change, because we've already counted the car in 2006. All right, the next one in the circular flow diagram, it's the households that supply the factors of production. And then this is relevant to GDP because there are three ways to calculate GDP. The one we usually use is the expenditures approach, where we count up all of the spending in the four sectors: consumption spending, investment spending, and so on. So all of the spending on production. But the alternative approach, because remember the income expenditure identity, the alternative approach would be to count up all of the income earned in households by supplying the factors of production. So we could count up all the wages, all the rent collected, and so forth. All right. But it's the households that supply the factors of production. Think about it in terms of labor. Who owns your labor? Not the company you work for, you. And you supply your labor to your employer at the cost of a wage. Number six is pretty straightforward. This is using the expenditures approach to GDP. So we're just adding up the consumer spending, $175 billion. We're ignoring income taxes. We're adding the consumer spending to investment spending, $30 billion. We're ignoring the corporate taxes. Then we're adding the $75 billion in exports and the $40 billion in government purchases. And then the last step, and don't forget to do this, remember we subtract imports. We have to subtract imports from exports. So that'll leave us with $220 billion. All right, next is number 7. This one also is pretty straightforward, so we have to figure out what counts. Clean air is a non-market transaction. So far, nobody's selling clean air. Child care that a father provides to his child is also a non-market transaction. I don't think that the father is selling his child care services to his child. An automobile purchased in Sweden, or produced in Sweden, would count towards Sweden's GDP. The fact that it's a U.S. firm that is producing that automobile in Sweden doesn't matter. We look at where it's produced. D would count. This would be an export, a car produced in the United States and then exported to Europe. And then medical services that were not provided, that would be another non-market transaction, and also a limitation on GDP when you think about it. So if medical services are provided, we could count that in GDP, probably in the consumption sector. But if they're not provided, there's no way to account for that in our GDP. If there's just healthier people who are getting better health care, GDP doesn't calculate that. All right, so next is a tricky question. GDP is equal to, and this is the income approach, the sum of all income paid to all the factors of production. So this is the alternative to the expenditures approach. But there are some tricky distractors here. So it's not a consumer spending on final goods, because consumer spending would just be one sector. Remember, there's consumer spending, investment spending, government spending, net exports. B is really tricky, the total value of production of all firms. So where it says value of production, it's not the value of production because that would include intermediate and final goods. This is where you have to really know your definition of GDP down cold. Remember, we don't count intermediate goods in GDP. So if this said the total value of production of final goods, then B could also be the correct answer. But because it just says value of production of all firms, that would double count both intermediate and final goods. And as a review, intermediate good rather is something that's used in the production of a final good. So if you buy a car, we're going to count up just the value of the final good, that car, in GDP. We're not going to add the value of the tires, to the value of the transmission, to the value of the AC, to the value of the glass in the windshield, and so on and so forth. We only total up the value of the final good, which would be the car, right? So if this is super confusing to you, you want to study the difference between intermediate and final goods, and you want to do that before you take your Unit 2 test. So D is under both over and under inclusive. So we have this total value problem, right? Because we're only counting final goods. And then we have domestic firms. We count the production of foreign firms that are located domestically too. We also wouldn't count production if it's a domestic firm producing stuff overseas. So GDP includes the value of the total production of all final goods produced domestically within a country, but we'll count goods that are produced by foreign firms in that country. For example, if there's a Swedish firm producing furniture in the United States, we don't care that the country is, or that the company is Swedish. If they're producing the furniture in the United States, they count. And then E excludes domestic firms that are located domestically. So you kind of have like between like A, B, D, and E, you kind of have a definition of GDP, but each one is missing a little piece. All right, number 9, which would count a movie ticket, that would be a consumer good. A is a non-market transaction because you're volunteering, so there's no value, there's no market value. It means there's certainly value, but no market value that could be counted in GDP. B is a financial transfer, just moving money around. D would be an import, and E wouldn't count because it's a used car, so that car would have counted the year that it was produced. All right, number 10, C is why transfer payments do not count. Transfer payments don't create anything. You're just moving money around, switching money from one taxpayer or one group of taxpayers to someone else. And then 11, hopefully most of you got this right. I'm trying to remember, and I think most of you did get this right. New construction, whether it's a new home, new school, new hospital, whatever, always counts towards the investment sector. And that's because the year that it's constructed. So the year that something is constructed, the construction of that building will count towards the investment sector in GDP. Subsequent years, if it's a home, for example, that home will generate what are called rental services. So every year that the home is occupied, the Bureau of Labor Statistics will calculate a fair market value for the rental value of that home. So like if you turned your home into an Airbnb, how much could you get for it? And then that value is added into GDP. But the year that it's produced, or it's constructed rather, it always counts towards investment. I'll say it once more, new construction always counts towards investment. All right, that's it. If you have questions about your test, then send me a message on Remind or email me. Have a great weekend.